Welcome to the Canadian Investors Course, Session 2, Income Investing Commentary. Remember the terms of use and disclaimer slide? Here it is again. The authors of these videos and articles cannot assume any responsibility for what any viewer or reader might choose to do with this educational information. From time to time, the authors may express certain opinions in these videos or articles. An opinion is an interpretation of the facts at hand. The author of this video or article may or may not hold positions in any of the financial instruments discussed. So what are we going to talk about? We're going to talk about bond market potential danger, the fact that maybe it's not really different this time. We're going to encourage you to understand what you own, not to become a pie chart victim, and we're going to talk about rate reset preferreds. On item 4, don't become a pie chart victim, here's where we're going to give you the answers to the quiz which we discussed in segment 2 earlier on. So, what's the bond market potential danger? Well, you already know by now. It's the fact that interest rates are very low, and if they go up, you're going to lose money on your bonds. It's all about math. And one of the big advantages of bonds when used in conservative portfolios is price predictability. When you're in a declining interest rate environment like we were since 1982, price predictability was pretty easy. It was pretty likely that bond prices were going to be flat or go up as interest rates continued to fall. Interest rates were falling for a number of reasons. Now they've fallen to such a low level through overstimulation of the economy that at some point, maybe now, interest rates are going to start going up. And if they do, if you have a substantial component of your investments in bonds, that might be a very painful experience, one that you might not outlive. So, let's say you buy $100,000 of a 10-year bond for $100 with a coupon, an interest rate of 3%. So, as a reminder, what happens to the bond price if interest rates go either to 2% or 4%? Well, like we said before, if the interest rates decline a point from 3% to 2%, the $100,000 bond can be sold for $109,000 and change. Conversely, if interest rates go up 1%, so they go from 3 to 4, the bond will be sold for $91,825. So in the first case, you made a profit because interest rates went down, bond prices went up. In the second case, you made a loss because interest rates went up, therefore bond prices went down. And clearly, if you remember from segment 2, this was a 10-year bond. If it was a 20 or a 30-year bond, this effect would only be amplified. So, is it really different this time? In 2008 to 9, the global financial crisis left a huge overhang of unusually low interest rates. And in fact, people thought, oh my God, they can't go any lower. But in fact, they were flat, and they subsequently did. But now we're starting to see interest rates climbing, so that is probably over with. Huge capital gains were earned as a result because interest rates were very low, and the bond prices were very weak because there was concern about the fact that interest rates were going to rise, but in addition, there was a complete lack of trust. So the credit quality of the bonds was being ignored, and you could buy bonds very cheap because nobody trusted anything. But looking at that issue of short and long-term bonds, would you buy longer maturity bonds now? Maybe do the math. You look at this list of bonds we've got here as of August 2016. A 5-year Canada bond has a 0.58% interest rate on it today. Back in 2008, the interest rate was 4%. A 10-year bond pays 1.05 today. It was also 4% in 2008. A 20-year pays 1.62 today, and it was 4.25 back in 2008. And equally well, a 30-year pays 2.18, and it was 4.75. So clearly, that drop in interest rates was very good for the bond market, but that's probably over now. Clearly, a lot of money has been made in bonds, and people are buying bonds today based on past history, not the prospect of future performance. This is why it's so important to understand what you own. Look at this BMO bond fund, which moved up as interest rates fell. But let's look at this same fund on the next slide and compare it to the Canada bond yield. Oh, the bond fund went up in value as Canada bond yields went down. So no surprise that the bond fund did well. The question is, can that continue? Right now, Canada bond yields are at a historic low. They're lower than they were in the 1930s depression. So the question is this the time you'd want to lock in a rate? Let's say you're a conservative investor. Would you want to lock in a rate at this environment, wait 20 years to receive your fraction of a % per year return? You might be able to do better with your money. Maybe you'd be better off just standing at the sidelines and buying a short-term bond and rolling that over on a regular basis until you know what better to do with it. So let's come back to the pie charts. Remember, we said we were going to answer the questions. Well, look. Number one, the one with the most green, which is the most fixed income, that's called a balanced investment. And the further you go up the scale, number two is considered, with no bonds, is considered aggressive growth. But based on what we've just talked about with the bonds, do you actually believe that the number one investment is actually significantly less risky than the number two investment? My suggestion to you is the answer to that question might be no. And then look at number three. Number three is supposed to be the most conservative of all these investments. And based on what we've just said about where interest rates are, does that feel like the right answer to you? Now, here's the thing. If you have one of these conservative portfolios and it was sold to you as a conservative portfolio, and you're beginning to feel really uncomfortable because you're thinking, gosh, this isn't very conservative, and what can I do as a change? Maybe this is the time when you have to go, when you're finished looking at this segment, which will be in a slide or two, go back to the main website, look for the postal code locator, plug in your postal code, and that'll provide you the name of an advisor who you can talk to and ask some questions of. And these people are well versed in this subject, and they'll be happy to talk to you about it. If there's only the cost of a phone call, and that phone call is virtually free. So it's probably worth your while at least investigating it. If you have investments, say with a bank or some company that has put you into supposedly conservative investments and they haven't done anything about it, you have to ask yourself whether they've really served your interests or their own. Now, there is another idea to look at, and that's rate reset preferreds. Why would you look at rate reset preferred shares? Well, a preferred share, as you know, stands in a pretty good standing in relation to the dissolution of a company. So if something goes wrong with a company and you own a preferred share, unless it goes bankrupt with no assets, chances are you're going to get something out of it. So that's a little bit of a relief as well. But as well, these rate reset preferreds are essentially a little bit of a shelter against rising interest rates, because the way they work is they're issued with one a yield at the time of issue, but in the prospectus there's a clear path to how the interest rate on the preferred share will be reset, typically 5 or 6 years out. So in 5 or 6 years time, for example, maybe the yield at time of issue was 5%, and a Bank of Canada bond might pay, I don't know, let's say 2% in today's environment, or less, and probably even less than that, 0.5%. And so if the reset is a 5-year government of Canada plus 4.5, that's saying that if based on the 5-year government of Canada today, plus that 4.5% reset, 4.5 plus half is 5%. So really, the 5% yield you're getting is anticipated into the reset down the road. Now, if the 5-year Canada bond were to become significantly more valuable, let's say that they're yielding 2%, but 5 years from now, so 5 years from now they're yielding 2%, then 4.5 plus 2 would be 6.5%. Conversely, if 5-year bonds were yielding 0, then of course your new interest rate at that time would be 4.5, which would still look awfully good in relation to that. So these are a pretty good vehicle for investors to look at who need income and want some inflation protection. Also, they carry a little secret advantage. That's the dividend tax credit, because those numbers that we mentioned were not interest payments, they were dividend payments. And so not only do you get the advantage of a good yield, no matter how you look at it, but you get the dividend tax credit. So instead of earning 5% as the equivalent of a GIC, you're earning 5% as a dividend, which is sort of like earning 6 or 7 in after-tax dollars. So that's kind of nice as well. Now, when you're buying preferred shares, it's pretty important to pay attention to the credit ratings, because sometimes you'll see preferred shares that look very attractive, but they're P3s. And sometimes the P3s are the ones that are the most sensitive to the market. So the ideal situation is to look for good quality preferreds, in other words, P2 or better, which are paying a yield which appears to you to be satisfactory. Now, how do you know that? Well, this is another example of where you probably could do with some advice. So maybe you need to go to your postal code indicator as suggested before, look up, punch in your postal code. The website will give you back a name of a trusted wealth professional in your area who you can talk to and who's familiar with preferred shares and can explain to you how they work and to give you some examples or help you find ones for your accounts. That's the end of the commentary for the bond section, session 2. Thanks for listening.